Hi guys, this is Terry with Futures IO. It's my honor to welcome back John Grady from No BS Day Trading for today's webinar, Choosing the Right Market. Today's webinar is sponsored by Jigsaw Trading. If you have any questions, you can type them into the questions box and we'll do our best to answer them at the end of the event. If you're watching this on YouTube, please do us a favor and give us a thumbs up if you enjoy the webinar. Also, please feel free to share, comment, and subscribe to our channel. It really helps a lot. Don't forget that you can also follow us on Facebook and Twitter at FuturesIO. And I'd like to direct your attention to our current webinar schedule. You can view this updated schedule on our homepage at www.futures.io. Without further delay, I'll hand it over to John.
All right, thank you, sir. I'm sorry to say, I don't have the share screen. Ah, there it is. Okay. Let me pull this up. All right, can you see I have it on my homepage right now?
Yep, looks good.
All right, cool. Thanks, Mike. Okay, so thank you very much for having me back, Mike. I appreciate it. I guess the last presentation went pretty well, so I'm hoping that I'll live up to expectations again today. And thanks a lot to Peter at Jigsaw Trading for sponsoring this. I do use this platform. I prefer it over others just for my style of trading, so if you haven't checked it out, definitely check it out. It's a really good market depth tool. And with that, we will get right into today's presentation. I had been thinking about putting together a presentation on choosing the right product for a while, and the reason is because a lot of people struggle with this in the beginning. So at least a couple times a month, I get emails from people, and they're trying to learn, they're trying to get into it, but they don't know where to start, okay? So let me preempt this with, I trade predominantly off the order flow, so predominantly off of watching the ladders, the order book, the depth and sales, and not so much off main technicals, okay? And I covered that in the last presentation, so I don't want to focus too much on that today, but what I'm going to focus on is if you're watching the order flow, how it makes a difference depending on if you're trading mostly highly liquid products or products that aren't very liquid, all right? So the way that I want to start that is I have some documents that I'm just going to pop up throughout the course of the presentation today. And these are my notes to sort of help me stay on track and not ramble on for too long. And so the first thing that I want to talk about is prop firms. So I actually did work for several prop firms. I worked for an equities firm when I first started. I worked for a couple of prop firms that were futures firms in Chicago. And so frequently when I get emails from people and they're struggling, the first question I ask is, what are you trading? And usually what they say is crude oil or gold or the euro, sometimes the Emini S&P as well. But often where they're starting is with very, very thin, fast products. And so the first thing that I typically suggest, you know, if a person wants to try something different, is to look at a thicker product. Now, with prop firms, and we're talking here about prop firms that actually hire people, like they go through the process, they interview people, and they bring you in and put you on a desk in their firm. Most prop firms do not put new traders on products like oil or gold, and often not even on equity indexes. New traders are usually only allowed to trade very liquid products. The interest rate products are standard for new hires, something like U.S. Treasury notes or bonds, and the bund, bobble, and shats. If you talk to guys that are in Australian prop shops, you'll see that they're often trading Australian bonds. And if you talk to guys in Canada, what you'll see is they're often trading the CGB, which is the 10-year Canadian bond futures contract. And I know a guy up there who traded for a fund, and everybody in the office was on the CGB. Sometimes traders trade them outright. Sometimes they trade spreads. So spreads are also very popular in most firms. It can be a spread between different products, such as a knob, which is the 10-year note against the 30-year bond. And by the way, if you don't understand this at the moment, don't worry about it. It's not a big deal. You'll get it, and it takes a little bit of research to bring yourself up to speed on it. Or the FIGHT, which is the 5-year note against the 10-year note. It can be calendar spreads, like the September contract against the December contract in the same product, or it can be a spread between the futures market and the cash market. If traders trade stock indexes, they're usually only trading the Emini S&P or maybe the Euro stocks if they're in Europe. They're usually not on the Nasdaq, Dow, or DAX. So when I was in my office, nobody was on equity indexes at all for the first year they were in business. Once they progressed a little bit and started building new desks, they did put some people on equity indexes, but in the beginning, everybody was on interest rates. So prop firm managers know their traders are far less likely to get hammered if they trade more liquid products. All prop traders usually lose when they first start, as do all traders in general, because it's a learning curve. But they're going to lose less and have less volatile swings if they are trading very liquid products, okay? So if they can prove themselves in liquid products, then they may be given permission to trade thinner products. So that's where it starts. And I wanted to start with that so that you understand this is not just my opinion. It's kind of how it works within the industry, and if you talk to other people who have worked for other firms, they'll tell you the same thing, okay? So why is choosing the right product important? It's important because a lot of people, when they first start, they think they can use a one-size-fits-all mentality, and they usually think that because they're trading based on technical analysis. So they start learning about trend lines and patterns and candlesticks and all of this, and you look at that and you think that you can apply the same strategy to every market, and nothing could be farther from the truth. And I'm going to go through some sample trades and some live footage that I recorded just to kind of demonstrate the differences. But let me just cover this very briefly. So when people first start trading, they're often drawn to the most volatile markets because it seems like those are the markets which offer the best opportunities for making huge sums of money very quickly, particularly if you're only trading one or two contracts. So keep that in mind also in the beginning. A lot of people start trading volatile products because they have small account sizes, so which really you should definitely not do at all, but that's what they do because they're trying to put maybe $2,000 in an account and they see a big move in a thin market and they think, man, I could have doubled my account size, in one day if I'd been trading this market. But what they don't realize is if you become, good at other markets which are more liquid, you can make more money trading bigger size for smaller moves. So they often start with crude, gold, the DAX, some thin markets which have large intraday moves. They're appealing because, like I said, it's possible, although not probable, as I wrote, to make 2,000 or 3,000 or more per contract on a very busy day. More liquid markets, which are not as volatile, may only move 200 or 300 per contract in a day. So a crude oil or gold trader may make or lose 1,000 per contract in 5 minutes on a big run, and it's very rare to see that kind of move in the E-mini S&P, the notes, the Euro stocks, the bond, or other highly liquid markets. The next paragraph here is just about boredom. A problem for many traders is boredom. So if a guy's been watching crude for 6 months, he might start watching the Treasuries based on my suggestion, and if he's watching during a slow week, he feels like he's watching paint dry. Now, if you watched last Friday during non-farm and you watch today, you'll know that this is not true, but that can happen. So sometimes I direct people to like Treasuries, and they watch during a slow period or during rollover, and they think that it's boring, and they go back to the crude oil market. However, trading for a living isn't about excitement, it's about money. And if you obtain better results from trading a slower, more liquid market, then that's the market you need to be trading, right? A question which most people never ask and generally can't answer is, do I have a true viable edge? So by viable edge, what I mean is, are you consistently making calls that have a better than 50-50 chance of working? Is there actually a solid reasoning behind the entry and exit? Is your performance better than random results? And is there something which is helping you predict the future? And again, just bear with me while I get through this. We're going to progress the trades in a minute, but this is very important to understand the topic today. Try to remember when you're trading that you are attempting to predict a future over which you have no control. Okay, what do I mean by that? What I mean by that is you can't move the market. At least most people who will be watching today can't move the market. So by move the market, I mean you're not trading hundreds or thousands of contracts, which might actually be the support area, or might actually be the amount of size which is required to trigger off a stop run, let's say, okay? Most people start trading 1s, 2s, 5s, maybe 10 contracts, and you're up against guys who are trading thousands of contracts. So that was something I discussed in the last presentation. So you have to realize that what you're ultimately trying to do is you're trying to get in front of larger orders that are going to cause movement in your direction, okay? And so the reason most people don't have a viable edge is because they forget about that premise right from the start. In a liquid market, there are times when hundreds or thousands of contracts trade at one or two prices, and that information can help a trader determine future movement. In thin markets, there are areas of high and low volume, but you are often at the mercy of the next 50 or 100 contracts which trade, and those trades can start a chain reaction which takes the market 20 ticks in one direction or causes very nasty whipsaw type action, right? So if you trade crude or gold or the DAX, let's say something like that, if you've watched it for even a week or a couple of days, you'll see areas where it may only take 10, 20 contracts to set off this chain reaction, which is predominantly HFT, driven movement. And so if you're trading a liquid market like the ES or an interest rate market, or maybe the Euro stocks, you can actually see a few hundred to a few thousand trading at certain spots, and that can sometimes clue you into movement, all right? So in my experience, trying to pinpoint the best entry and exit prices is much more difficult in thin markets. Most retail traders try to pick profit targets and stop-loss prices using some basic form of technical analysis, which is often not any better than a random guess. So to kind of illustrate this point, and I'm not picking on people who say this, I'm just trying to make a point and kind of make you think outside the box. I recently had an exchange with a guy who told me, he was like, hey, I made some money by identifying a swing low today. So I asked him a few questions, and the first question, of course, is do you consistently make money by identifying swing lows? The answer to that is usually no. And one of the problems is when it doesn't work, they don't know why, right? So that's problem number one. The next question is who coined the term swing low, and what does that mean exactly? So when people fire off terms like swing low or overbought or oversold, it's a very subjective term, and everybody has their own idea for where the pivot point may be and why they feel it's that way. And people often ask me, well, isn't reading order flow subjective as well? And it's far, far less subjective, and I'm going to, again, go through that as we progress today. What data does this person use to determine if it would be a swing low? Again, we're back to what are you looking at that's making you decide this is a swing low area? And then, most importantly, or what I think is most important, is this person or is somebody going to be working a buy order for 5,000 contracts at that swing low price, all right? The answer to that question is always no, because anybody who's working a buy order for 5,000 contracts is not going to broadcast that news ahead of time. Why do I say that? I say that because a price or group of prices being called a swing low, according to someone's data projections, is not what stops a down move. Buy-side demand overwhelming sell-side supply is what stops a down move. Size stops a down move or an up move, as the case may be. So the market might be moving down, and you may have a projection that this area, quote, should be a swing low. But unless a lot of buy-side orders come in that area, your swing low is not going to hold, right? So rather than responding to your projection of a swing low, it's better to respond to actually seeing size come into the market and start bidding and holding at those prices first before you just randomly put a buy-side order out there, okay? So bringing this back to the topic of choosing the right market to trade, in my experience, it's easier to make consistent reads in liquid markets because you can see that size trading, and it makes a big difference when it comes to trade management, okay? Thank you for sitting through that. It will come into play as we progress. A couple bullet points we're going to go through today. Identifying logical profit targets and stop-loss points, risk-to-reward ratios, speed, slippage, size limitations, and diminishing returns, and then what I call the tick-to-commission ratio. So let's start with these two because they go hand in hand. Identifying logical profit targets and stop-loss points and risk-to-reward ratios. So when I say thick markets versus thin markets, this is a group of what I would call fairly thick markets. You have the 10-year, the 5-year Treasury notes, the E-mini S&P, the Euro stocks, and the bund, all right, moving from left to right. And what you'll see on each one of these ladders is that there's a lot of size. I mean, with the 10-year notes, you see thousands, right? 3,000, 3,000, 1,300, 3,000. With the 5-year, you see 800, 400, 1,700, 1,700. Not all that trades, but usually you have at 5, 6, 700 at every price. The E-mini S&P, as we know, could be anywhere from 250 to 1,000 or 2,000 at each price, and so on with the Euro stocks and the bund. The bund is a little bit more thin, so I don't usually suggest people go with that at first, but it does have some size. Now compare that to thinner markets such as crude oil, gold, the euro, the Dow, or the DAX, all right? And if you look at these ladders, what do you see? 16 by 7, right? 11 by 26, 3 by 22, and just it's very, very thin size on each one of these products. So let's discuss why that's important with the idea of trade management. Excuse me one second. Had to get a drink of water. So when I'm pulling out recorded trades to try to do a presentation like this, I don't just try to pick trades where like, hey, I made a winning trade and I'm a genius. All right? So I don't want anybody to think that I make winning and losing and break-even trades like everybody else. What I try to do is I try to find a trade or some sample trades that illustrate the topic at hand. And so what I've done is I have a 10-year trade that I made, and I have a crude oil trade that I made, and the entry is very similar, but I'm going to go through them so you can see the difference in trade management. Now, in this particular sample, Treasuries were moving up, and it looked like they were hitting a point where they may stall out and retrace a bit, okay? Why is that? There's a combination of factors, and that's not really the topic at hand today, but it's a few factors involved, ranging from volume trading to the context, and also just sort of knowing how your market behaves. And so what happened is I ended up taking a trade here at 29, and I'm not going to go through the entire thing, but you can see that right there I ended up getting short at 29. And in this scenario, based on understanding a more liquid market like this, I know that I'm pretty much at, if I'm right, I'm at the right price. So in other words, the market really shouldn't go through me here. And so it shouldn't even go to 30 or 30.5. So from a risk to reward standpoint, right, I'm only risking 2 to 3 tops on this trade. And I know that if I'm right, I'm going to at least get 2 to 3. So I'm definitely going to get 1 to 1 in this scenario. But if I'm right in a bigger way, I might get 4, 5, 6, maybe even 8 ticks. It depends a lot on what's going on, and I try to feel it out as it's happening. But I know that I'm at least getting a 1 to 1, and it won't take much to get that 1 to 1. And I might get 1.5 to 1, 2 to 1, or 3 to 1 on this trade. So it's common in this situation when you're dealing with liquid products and you can see some volume trading that you can identify areas like this. Now, I'm not saying it's easy. I'm not saying you're going to do this overnight. I'm just saying that it's easier to find this in a liquid market than a less liquid market. And so in this particular situation, I'm just going to scan through a little bit, so it's going to move fast. The market bounces back and forth for a little while, and then eventually it does end up dropping in after it goes to my price again a couple times. And I am scanning forward, so so you understand it's not real time here. It takes a while for this to play out. And then right here, I end up deciding that based on what I know, I probably need to scalp the 4 ticks at 27. Okay, and it took about 3.5 minutes for this to play out, and I end up covering the trade for a 4 tick profit right there. Now, it doesn't look like a lot, and I realize that traders who trade fast markets, they're like 4 ticks, what is that? That's nothing. But you have to understand this is how more liquid markets behave. And so a very important point to understand is that, you know, 2 4-point winners is the same as 1 8-tick winner, right? Or 3 4-tick winners is the same as 1 12-tick winner. And it's often a lot easier to identify a 3 or 4-tick winning type trade, particularly in a range-bound liquid market, than it is to sit there and wait for 2 hours and hope that you make a 12-tick winning trade. And that, of course, goes back to the idea of responding to what you're seeing in the moment rather than having a preconceived notion that, hey, I know where the market's going to be in an hour from now. Not to mention, if you think you know where the market's going to be in an hour from now, you may very well miss a lot of smaller opportunities in that hour. There may be 3 opportunities to scalp 3 or 4 or 5 ticks over the course of that hour. And if you sit in a trade for an hour, you may not even make 10 ticks on your one trade because you sit through a bunch of chop. All right? So let's compare this. You know, it's a slower type situation with a lot more volume that trades, but it pans out and I'm risking 2 to 3 and I end up making 4 on a trade like that, right? So this next situation is an oil trade. Now, I will point out to you that this was a sim trade because I don't trade oil and I didn't want to just, you know, blow through a couple $100 trying to find a trade for a presentation. But the idea is still the same and the execution is the same. And in fact, it was by watching price action that I decided, hey, you know, this might be a decent short scenario in crude oil. But here's the difference. You'll see that I'm short from 41, okay? With crude, I cannot set a 2-tick stop loss. It just can't happen. As you see, the market's already printed 2 ticks above me, so I would have been stopped out anyway had I used a 2-tick stop loss. And really, I can't even use a 3 or 4-tick stop loss. You know, if you've watched crude or a thin product for much time, you know that the market can move through you very easily by 2 or 3 and then come right back to your price and then maybe in the direction of your price. And this is one of the things that I'm trying to cover here is how do you establish a very logical stop loss point in crude oil? So some people might say, well, the market's moving up, why are you shorting anyway? Well, I'm shorting because the price action is telling me that the market may stall out here and go back down, the same way it did in the Treasury trade. Okay, so the read itself is not, you know, it's a valid read. It is a valid read, but the problem arises with where is my logical stop versus a logical profit target? And in this situation, as you'll see when I scan forward a little farther, there was no clearly identified resistance level of any kind above this. There was no resistance, technical resistance, on a chart, on a daily, on a minute, anywhere. And so you're sort of in the situation where you want to take advantage of a potential move and a retracement where the market might stall out and pull in, but you'd have no real clear concept of where your stop needs to be, right? Because I don't want to blow out at 44, 45 and have the market come back into 31, right? So for this particular sample, what I did was I said, okay, let's go for a 1-to-1. We'll set our stop at 53, which is a 12-tick stop loss, and we'll go to 29, which is a 12-tick profit target, and this will be the 1-to-1 in a crude oil trade, okay? And so it took a while for this to play out, and ironically, it played out better than I could have imagined, but the market trades here a bit, and as it trades, you know, it pulls in a little bit and then hovers in this area. And even this hovering kind of makes me think I'm on the right side. I'm pretty sure I have the right read here, but let's just feel this out and see what happens. And then it jumps right there a little bit. Now this is what I'm talking about. I'm going to back this up. Right there. So now if I have a stop at 46 or below, I'm stopped out of this trade, right? So once again, this is where I'm trying to identify 3-tick, 4-tick, 5-tick, 7-tick, 8-tick stop. I mean, realistically, where does a stop need to be in this situation? And it jumps a little bit, pulls back in, and I'm going to fast forward down. And there's probably a little bit of a lag coming through, but I'll pause when it gets there. And it takes a while, and finally it does pull in. Now, here's the interesting part. It pulls in all the way to 46.30. It actually prints at 29, which is where my order would be, but it only prints a few contracts, and my order was not filled, as it would not be in real life, you know, because it was at the end of the queue. And so what happens here is you see they print 13 contracts at 29, and then the market jumps off of there a little bit. Now, realistically, if you're trading oil or gold or any of these products, you need to be using probably an automated trade management type system that's going to pull a trailing stop down behind the market once it moves in your direction. I mean, that's realistically how you need to trade these markets. Point and click on crude and gold and the DAX and the Dow it's pretty much game over for point and click. If you want to compete with the HFT programs in the world and thinner markets, you need to be using some kind of an automated, at least once you're in. You may point and click to get in, you know, with a market order, but once you're in, you need to kind of have an idea of where your stop should be set, and you should have a trailing stop following your order as the market moves in your direction. The reason I let this play out is because this was for demonstration purposes, right? And in reality, as soon as the market bounces there, it's only one tick away from my exit price. I'm not realistically going to risk giving back 10 ticks to try to get that extra one tick, right? Nor should you ever do that, and that's a problem a lot of people have. The trade might be 8 or 10 ticks in the money, and they want those last 2 or 3 ticks, and they end up risking the 8 ticks of profit or 10 ticks of profit to make another 2. And they never view it that way. They always view it as I risk 12 to make 12. But in reality, at this point, I'm now risking 10 to make 2 if I let it come all the way back to my price, right? A really fundamental concept that a lot of people don't get when they first start trading. So what happens is it trades around this area, and I just let it go, you know, for, like I said, to see if it would get the fill or not. It goes right back down again to 31, never gets to 29 again, or excuse me, 29, yeah, where that order was. And I start moving the order up, and of course it doesn't get filled, and then it comes all the way back to the entry price of 41. And I just scratched the sim trade because it made my point very loud and clear. That's kind of the difference between liquid and illiquid products. And so a person might say, well, if I had risked 8, I would have made 8, and, you know, been in a situation where I got 1-to-1, which is true. And if you are really skilled at trading thin markets, then maybe you can get a feel for where your stop should be and where your trailing stop should be and whatnot. But usually new traders have no concept of how to do that, and that's why if you learn on more liquid products, you tend to do better once you try to switch to thin products, if you choose to do so. And then what you'll see a little while later is that the market actually did go all the way up to just below where I had that stop loss, right? So it goes all the way up to 50, stalls out, pulls back in, and then comes back to 41 again. And so you just get these really wide ranges, and it can make it very difficult to make any kind of a clear read. What I wanted to show on the chart here was that there wasn't really any resistance point, and that's what I was trying to show, is that the only resistance showing on a chart would have been 45.90, 45.95 in this area from the previous day. You can see it, oil went up, and then stalled out, came in, and that was it. And so going into the next day, when it's chopping in this area, once it finally gets through, which is exactly where that was, which is what I'm showing you, there's not really a spot up here that's a logical resistance point. So if you're trying to make a legitimate read off the order flow, you might be reading the volume right overall, but again, trying to find that stop loss point that's the right stop loss point can be very, very difficult. Now, let's move on to the next bullet point. Speed, all right, or what I call HFT domination. these markets react so fast these days that, again, if you don't have that automated strategy in place, you just can't react at the same speed which these orders can react. And so as an example of that, we're looking at gold here, and it's trading at the low of the day. It's at 13.1910, right? It's going to snap, and it's going to be 10 ticks lower in a matter of 1 second. So if you see it's trading at 13.1910, and then there it goes, right? 13.1820. And so it breaks this level and snaps down really quickly. If you're not using a stop order, you're never going to get filled. And if you are using a stop order, you might actually not get filled until 60 or 50 or 40 because of the volume that's trading. So it breaks from 1910 to 1820 in a matter of a second, and then traces right back up to 1910 in another 2 or 3 seconds, right? If I am in a Treasury trade, so this is down and up, right? Let me back up for you. If I'm sitting in a 3 or 4 tick trade, winning trade in the Treasury markets, that's never coming back on my price without me taking a profit. I don't have to worry that a few orders are going to drive the market 4, 5, 6 ticks straight back through my entry price, and I'm going to be caught in a trade that went from a 4 or 5 tick winner to a 2 tick loser. I mean, you can also bring, your trailing stop down or a break-even stop down, but you don't want to be in a 4, 5, 6, 8, 7 tick winner and have it be a break-even trade. It defeats the purpose of short-term day trading. So with a liquid product like this, that's not really an issue, whereas if you go to what I just showed you, sorry, trying to find it again, you have that situation where it snaps and comes back on your price so fast that you don't even know how to react to it. And this is what kills a lot of traders, is they try to play a break like that. They play the break after it happens, so they're selling at 1850 or 1860 or 1830, down here, and immediately the market is back 10 ticks in their face. And then once it's 10 ticks in their face, they don't know if it's going to stall and then come back in again, or whether they should bang out and take the loss, or now they have to wait for it to go to 1320. It turns into this really confusing situation, and they have no idea what to do, and they end up, either acting too late and getting in after the market's already broke 10, 12 ticks, and then getting caught as it snaps back, or they act at the right time, and maybe they get a trade-off at 1910, 1890, but when it snaps back, they won't take the break even, and then it turns into a 5, 6, 8 tick loser, and they basically get the deer in the headlights syndrome, right? And they allow a win to turn into a loss, which is what often kills people as well. So just to show, a chart of gold, this is what enamors people, and this is why they get into those kind of markets. You can very easily, I could show a chart like this and say, hey, look at this is gold, this is what you need to be trading. Look at the potential here. And they see a day like this, which was a different day than the one you were looking at, by the way. And they think, oh, all I had to do was buy here, and then the market skyrockets, and you make 1,000 per contract, and then later on in the day you sell it and it drops, and you make 1,000 going the other way. And it's very misleading. Those days are few and far between, and in the interim, people usually get caught in that kind of scenario which I just showed you, which is they just get whipsawed out of 5 ticks here, 8 ticks there, 10 ticks here, and the next thing they know, they're down 40, 50 ticks in the 10 market, and they're scrambling to try to find 2 25-tick winners to make all that money back, and they can't find one for the next 2 weeks, and they just continue to dig a pretty big hole. And so people look at this and they think, wow, what potential, and then I show them a Treasury chart like this, or they see a Treasury chart, and they just see a bunch of back and forth and slowness and not a lot happening, and they don't know how anybody can make money in this because it's so slow. But in reality, take for example an area like this where you have about an hour time frame here, actually more than that, 2-hour time frame, But in that 2-hour time frame, it can sometimes be possible to just sell and buy and buy and sell and sell and buy and buy and sell 3 or 4 or 5 times, and you can end up scalping maybe 9, 10, 11 ticks in a 4-tick range. And so the potential is there during slow days, not every slow day. I mean, they can be a little too slow sometimes. But Treasuries also move, and to illustrate that point, I scrolled back. The day before that, there was quite a lot of movement, and it was pretty busy. And the day before that, it was also pretty busy with a big down move right off the open. And the day before that, it was busy as well, which you don't always see in Treasuries, but massive skyrocketing type movement that happened the day before. If you saw today, the market had a big up run after 10 a.m. And then, of course, on non-farm last Friday, it was the same thing last Friday. Sorry, I was pausing. I was looking at something. So don't let the fact that a market may look slow prevent you from trading it. You may just be watching it during a slow week or a couple of slow days, and ultimately you might find that it's a better read. So again, to go back to our bullet points here, slippage in thin markets and its effect on P&L. Let me just show you this real fast. You may already understand this, but I'd like to share it. Let's take, for example, the Euro stocks versus the DAX. They tend to move very similarly at times. The DAX often moves, or not often, always moves faster on lighter volume. But let's take the idea of slippage just real fast. Let's say you have a stop order set at 56.50 in the DAX, okay? And you see that there's 8, 8, 9, and 12, okay? If you're doing a test or you're testing on a sim, and this is sometimes a problem when you're testing and not trading real money with at least a 1 lot, you think that you might be able to get the fill at these prices. But what happens is when it actually trades there, you don't get filled for 4 or 5 ticks past that price. Whereas in the Euro stocks, which is fairly liquid, I was actually already long, but that's beside the point. 785 was on the offer. If I have a stop order working at 32 for 10 or 20 contracts or 5 or 1, whatever the case may be, almost assuredly I will get the fill at 32. It's pretty likely that I'm going to get the fill there. Worst case, I might get 33, but because there's volume there, I'm probably going to get the fill at my price or only 1 tick past that. And so if we click ahead, what you'll see is the market actually jumps. And when it does trade, only 2 trades here, 2 trades here, 6 here, 7 here, 7 here, and 3 here, right? And so you have a grand total of, 27 contracts. That drives the market 6 ticks straight up. So in theory, you think you were filled at 56.50, but in reality, when that 2 lot traded, it triggered this 2, which triggered that 6, and all those orders beat your order to the market. And so you weren't filled until 58 or 58.50. So you end up getting 3 or 4 or 5 ticks of slippage on that order, and it skews, what you might think is the real risk to reward in a scenario like that. Whereas most likely in the stocks, you get the fill because 656 traded there. And now you might be long at 32 or long at 31. And the flip side of this is that let's say you have that stop set off similar to the gold trade, and you get the fill at 58.50. Well, now if the market suddenly snaps back 6 ticks on another 20 contracts, you're going to be sitting in a losing trade. Whereas you probably still have the chance to maybe scratch at 32, or worst case, take a 1 tick loss. Or in my case, I was already long at 31, and I can almost assuredly scratch the trade if I need to, depending on the situation. And I realize scratching trades is a novel concept to a lot of people, but it's valid in certain areas. All right, and then moving along, size limitations in thin markets and diminishing returns. Here's the deal. Even if you become proficient in thin markets, you're going to be limited to the amount of size you can trade with that strategy. So you may develop a strategy that works really well with 1 to 3 contracts, or maybe 4, let's say. But now let's say you're making some decent money with 1 to 3 contracts and you need to up your size and you're trying to increase your profits. If you start trying to trade a 30 or a 40 lot in crude or gold or the euro the same way you're trading a 3 to 5 lot, it's probably not going to work. So you're going to notice that your returns begin diminishing very, very quickly. You're definitely limited on how you can move size in these markets, whereas if you become proficient at trading the 10-year or the 5 or the Emini or whatever, you can literally trade hundreds, if not thousands of contracts if you were to ever reach that point. You know, that's obviously way in the distance, but if you do become proficient, you can trade that size in the same way. I mean, you can pretty much trade a 100 lot to 200 in the 10-year the same way you trade a 1 lot. Not always. There can be a little bit of slippage, but only of a tick usually. So it's very similar in terms of that. I mean, obviously, if you're trading 3,000, that's a little bit different story, but nobody here is probably at that level, I'm assuming, including myself. So again, if you're trying to learn a market and you want to make real money in the future down the road, is it better to focus on a market where you may be limited to trading 5 or 6 or 8 contracts the way that you know how to trade, or do you want to focus on a market where you're going to be able to up your size to 50, 60, 100 contracts potentially down the road? And then the last thing I want to talk about is tick to commission ratio. So the tick to commission ratio is something that for some reason you never see. I don't know why, because it's a common understanding in the industry, but you just don't see it much in retail material. What it is it's the price of trading a contract versus a tick size. Okay, and as a quick comparison here, I did 3 products. Crude oil is $10 a tick, and the Euro stocks is also $10 a tick. So you have 2 products that have the same tick size. All right, but the exchange fee for crude is $1.45 a side, whereas the exchange fee for the Euro stocks is 30 cents a side euro, which is currently about 34 cents a side US dollar. Let's just keep it the same. Say you pay commission of 50 cents a side, clearing an NFA of 5 cents a side, and you pay $4 a round turn for crude, and you pay $1.78 a round turn for the Euro stocks. $10 a tick divided by $4 a turn is 2.5. What that means is you have to make 1 tick for every 2.5 trades in order to cover commissions and exchange fees if you trade crude oil. If you trade the Euro stocks, you have to make 1 tick per 5.6 trades in order to cover commissions and exchange fees. And then if we scroll down and we're looking at, say, the U.S. Treasury bond, the Treasury bond is $31.25 a tick, and it's only 80 cents a side exchange fee, which is about $2.70 a round turn. So now you have $31.25 divided by $2.70 a turn is 11.5. That means you only have to make 1 tick per 11.5 trades in order to cover commissions and exchange fees. I can't tell you how big this is in the long run. Now, if you really become a good trader, you can eventually become a member of an exchange and lease a seat, and you can bring these costs way down. All right, but again, even when you do that, usually the CME products, particularly energies and grains, are going to be higher than interest rate products or the equity index products. And so if you're looking at long term, you know, for every 100 round turns you do in crude oil, you're paying $400. For every 100 turns you do in the Euro stocks, you'd pay $178. So you're basically giving the exchange, the CME, another $222 for every 100 round turns you do. Obviously, if you can trade crude like a champ and you can't trade the Euro stocks at all, you know, then yeah, of course you're going to pay the extra fee and you're going to trade the product at which you are the most proficient. But if you're not very good at crude and you're not good at the Euro stocks or the bonds or whatever, and you're trying to learn one of them, it makes a lot of sense to learn a product that has a cheaper exchange fee, because if you don't, you're just basically giving away money to the exchange, and you might do better in a more liquid product that has a cheaper exchange fee. Okay, and so to summarize, in the beginning, most traders should not focus on trading oil, gold, the Nasdaq, Dow, the DAX, or other very thin markets. I tell people not to trade Forex or CFDs, contract for difference. Some people would disagree with that, but most people I know who try Forex and CFDs lose. They're just different. They're not as transparent, and it's certainly not the best place to begin. Again, you should probably start with the actual exchange traded products, and if you become decent at those, then maybe you can branch out, but most people do not. Typically, you want to focus on equity indexes, the S&P or the Euro stocks, or interest rate products, 10-year, 5-year, 30-year, bond bobble, Australian bonds, and I say maybe something like corn. Corn is a pretty thick market at times, and there can be decent movement that can be read from the order flow, but the exchange fees are pretty high, and you also need to be seriously aware of limit moves. The grains can have limit moves up or down, and you have to know exactly where that price is if you're going to trade those products. Otherwise, you could get trapped in a limit move, and that's a really, really bad feeling. Once traders get away from the thin markets and start trading more liquid products, they usually see improvement within a few weeks. Not a guarantee, obviously, right? We all say this up front. This is not a guarantee of anything, but in my experience, if people break from thin products, they go to thicker products, they usually do a bit better. You know, I talk to guys, for example, that are in the Top Step Combine. I know there are some, you know, forum posts on Futures.io about that, and typically people who are on the Top Step Combine sims, they're trying to swing for the fences in oil and gold, and if they cross over to a more liquid product, they start noticing that instead of drawing down 10% or 20% a day, they only draw down 2 or 3% a day. Then they may make 2 or 3, then lose 3 or 4, and the really volatile swings in their P&L tend to disappear. Doesn't mean you can't lose, it just means you lose at a slower pace and you learn more while you're losing less money. So they begin to see how they can reduce risk in the liquid products. They see the benefit of better risk-reward scenarios. They see size influencing movement, and gradually the change begins to make sense. All right, and so with that, I'll back out of all this and turn it back over to you, sir, and we can do some Q&A.
Okay, if you have any questions, please type them into the questions box, and we'll start the Q&A. All right, let's see.
I hope I didn't rush through that too fast, but I just wanted to cover all that material and get it out there. I know it's going to be recorded, so people can at least watch it after the fact.
Yes. Okay, this person's asking, wouldn't you find the logical stops from the chart and the pivots or ATR for that product?
Okay, so that's a good question, and that goes back to what I try to illustrate in like order flow scenarios. In that particular, like for that oil trade, for example, right here, there was not one, and that's sort of the point. They had already gone above what would be considered a resistance point on a technical resistance point in terms of a daily chart, a minute chart. As far as an average trading range, it typically sets you too wide. And so what I was trying to demonstrate is you're in a situation where a lot of people decide they need to risk 15 or 20 ticks, but then they don't actually make 15 or 20 when they're winning. The market moves in their favor, and they use a trailing stop, and they only end up taking 10 ticks of a winning trade, but they were risking 20 on the downside. And so if you trade a more liquid product, you don't always have to be in a scenario where you have a technical resistance point. So for example, in this particular trade, this was not a technical resistance point. So it wasn't marked on a chart, and it wasn't marked based on a pivot point. And pivot points are very subjective. It's based on seeing a certain amount of volume and size just hold at one price, and the market can't get through it. You know, and so if you're watching the order flow, and this is what goes back to the original part of the what I was saying today when I first started in the first 5 minutes, you can identify large orders in areas of higher volume that tend to hold that may not be anywhere near a technical level. and you can make an educated decision based on that, versus always sitting and waiting for one spot on a chart, or having stops that might be way too wide in terms of a risk-reward scenario.
Okay. Let's see. How much as a rule of thumb, how much capital would you need to trade 1 lot, 10 lot, 50 lot, etc.?
It depends on the product, so and this is not, it's just the general rule of thumb in my experience. For day trading margins on the Treasuries and the Emini S&P, it's usually 500 a contract is what you typically can get. That varies from broker to broker. So typically you want at least double that, 1,000 to say 1,200 per contract. Obviously, if you were trading oil, your margin is going to be 1,000 a contract, or maybe 1,250 a contract. It depends on the broker, and you're going to need probably 2,500 a contract. And that may sound like a lot, but it at least gives you enough leeway so that you can take a little bit of a drawdown in normal situations. I mean, sometimes you're just going to get in the trades that don't work and lose 3 or 4 ticks here and there. But if you draw down that much, if you're trading on 1 lot in the S&P or the Treasuries and you draw down $700 per contract, you should stop trading anyway and reassess what it is you're doing wrong before you put any more money in your account and try it again. You're probably clearly doing something really wrong on a consistent basis. That's my thoughts anyway. What's your opinion on that? You have one?
Again, like you said, depends on the product, but me personally, trading something like the E-mini 500 or whatever, I say like 10 grand a contract.
Really?
Yeah.
Well, I guess you would do that if you're trading for much bigger position swings. Yeah. I mean, if you're going for like 20-point runs, then yeah, that would be a different scenario.
Let's see. Do you find? Okay, which session do you prefer, the AM or PM session?
I prefer the AM session, definitely. Your news releases are in the mornings, and they start typically at 8:30 a.m. Eastern Time. And like, for example, last Friday, I mean, if you trade non-farm, and most new traders should not, they should, at least in my experience, they should watch at 2 or 3 non-farm there. I mean, because from 8:30 a.m. forward, the market can just rock and roll till 11 or 11:30 a.m. I find that the PM sessions change somewhat, and the volatility changes, and the size and volume changes. And I know, as ES traders, the ES can have some good runs sometimes between 2:30 and 4, right? So I wouldn't discount the ES between those hours, but usually between the hours of 11 a.m. and 2:30 p.m., even in that market, I think it tends to slow down and be a lot more difficult trade. And so typically you want to be there during the news releases between 8:30 a.m. and 10:30 a.m.
Okay. Kind of piggybacking on that, are there decent trading hours other than the Europe times for the FSEX?
Yeah, well, you could trade them during the U.S. market hours as well. I've found doing a couple of sessions and presentations on that right off the get-go, which would be 3 a.m. Eastern, which is 9 a.m. Central European time, I believe. When the Euro stocks and the DAX and those equities come online, it tends to rock and roll in that first hour between, it would be 3 a.m. and 4 a.m. Eastern time. And it can continue on usually through 5 a.m. or 6 a.m. And then typically it hits a lull as well over their lunch period, but then it can pick back up when the U.S. morning session begins. So in Europe, you could probably trade the morning, take off for lunch, and come back and trade again around 1 or 2 p.m. and trade during the U.S. session, because often those Eurex markets will pick back up again during that time frame.
Okay. I know you mentioned it in the presentation, but there is a couple of people talking about the ES. They say you mentioned it's a liquid product. Would you suggest starting to read order flow in it, or suggest going to the bonds first?
I always suggest Treasuries first. I'm a little bit biased on that, and I admit that up front. When I first started learning, when I first attempted trading, it was the same as everyone else. I was trying technical trading, and I was in equities and then stock index futures, so the Emini S&P and the Nasdaq and the Dow. And when I got to the firm, no one was even allowed to trade that. So we were put on the 30-year bond and the 10-year notes, so I had no choice but to learn those products. After going through that experience and progressing through the years, what I come to find was there was a good reason for that. The reads tend to be a little more, I hate to say easy, but there are just times in Treasuries when you don't get whipsawed as easily as you do in the E-mini. And that's not saying there's not potential in the E-mini. I'll trade the E-mini as well sometimes, but typically for momentum type plays, because it'll really move, sometimes when the Treasuries might be sitting there doing nothing. What I do recommend is in the beginning you pick one product and stick with it. So if you're going to trade U.S. Treasuries, stick with the 10, the 5, and the 30. Bring them all up, watch them, trade those. If you're going to trade the E-mini, bring up the E-mini, the Nasdaq, the Dow, bring up the cash markets, right? Cash S&P, cash Dow, and just trade those markets. If you're going to trade Eurex products, bring up the Euro stocks and the DAX to watch the DAX. Focus on the Euro stocks or the Bund, and try to become a specialist in one market first, and learn that market really, really well. And where people get into trouble is maybe they're watching a market like the Treasuries and it slows down and they're doing okay and they've made a few ticks, and then they bring up oil or crude or the S&P and they jump into a product that they haven't been watching for the last hour or two, and they start firing off trades hoping to make that extra couple $100 that day, and instead they lose back what they made in their market where they are, specializing. So those are the markets that I typically tend to recommend.
Okay. And I tend to agree. When I first started trading, I started trading the Nasdaq. So I looked at everything, NASDAQs, everything, tech related, and tried to really focus on that. Let's see.
Yeah, and you should, and those stocks as well, because Nasdaq stocks affect the Nasdaq market, whereas they may not affect the Dow. So you got to learn all those nuances of whatever product you're trading, and if you will just focus on one market, you start to learn, for example, like what I tell people, the chart forms in your head anyway. If you watch it go up and down all day long, and you watch the volume profile throughout the course of the day, which is what you see on this left-hand side here, you begin to have a chart form in your head, and you start to really pinpoint areas of support and resistance and potential momentum and stop orders. So yeah, definitely stick with one product in the beginning.
Let's see. There's a person asking this. It says you, again, talking about ES, do you use the same type of trading when you trade the E-mini?
I do. With the E-mini, sometimes you need to have a little wider stop. It depends on the scenario, but really the only beauty of the ES to me is that sometimes it will run like a champ. Now, if you were watching Treasuries today, you saw them run like a champ as well. But it tends to do it more frequently, and so with the ES, I'm still looking for high momentum type plays, areas where there really are, it looks like there's a potential for stop orders to get set off, or it's just very clear that they're hammering it in one direction. And so I don't want to risk more than 4 or 6 ticks on an ES trade typically, because I'm often going for scalps of maybe 4 to 8 or 10 ticks or something like that. I mean, if it runs farther, that's great, but I like to, for my particular style and for a scalping style, I like to focus on the fast, easy money. So yeah, you might need a little larger stop in the ES, but the actual strategies and concepts are basically the same. I mean, it's just watching pressure and momentum and volume and trading it.
All right. If I wanted to start learning Treasuries using the Jigsaw Dome, do I need to watch all 4 Treasury markets, or would it be better to just start with one?
You need to watch 3. You need to watch the 10-year, the 30-year, and the 5-year, which is what you see here. On the far right, you actually see that this is the E-mini S&P on the far right. So that's not a treasury market. And the reason you need to do that is because there is an interplay between these markets, which is heavily spread related. And so sometimes you'll see something happen in one market that affects the other two. And so if you, for example, if you're just watching the 10-year, you may not pick up on the clue, but if you're watching the 30 and the 5, you may see the clue in the 5-year. Or if you're just watching the 5-year, you may not see the clue in the 30-year. And in fact, for anybody who may have been trading last Friday, if you have it on recording, if you'll watch after the non-farm is released, you'll see that the order that stopped the Treasuries from going up was in the 5-year. So it hit a wall while the 30-year and 10-year were still going, and then the 10-year and 30-year pulled back in, and all three markets stalled, and that was the end of the up move. So if you were only watching the 10 and the 30-year, you may have been trapped into buying at higher highs, whereas the 5-year clued you into the fact that the market may stop in that area. So you want to watch all three of them.
Okay. How many trades are you taking a day on average?
It completely varies. I know I get that question a lot, but on a busy day, I mean, I might fire off 15 or 20 trades or more even, just depending on what's happening, like last Friday. On a very slow day, I may fire off 2 or 3 or even none. I mean, there are certainly some days like FOMC, you know, if the morning of FOMC or the day before FOMC announcements, the markets are usually very dead, or the price action just isn't very good. It's very erratic and thin. Even in the Treasuries, it can be erratic and thin. And so if it's just bad action, then I don't take a trade at all, and I wait for a better day and a better place to risk my money. And that's a concept that's also hard to teach in the beginning. Well, it's not hard to teach, but a lot of people don't understand. You know, you don't have to trade every day. So you should only put your money at risk when the opportunities are there and you're in the zone and you're seeing what you want to see. And if that happens, you know, you trade till the action dies out. But if you log on and you're just not seeing anything at all, or the markets are super slow, you're not required to force a trade. And that's something to understand. I mean, this is not a normal job. And so a lot of people log in and they want it to be a normal job and they want to make money every single day and view it as a paycheck, but really your entire week might be made in one good day. And the other 4 days, you may only fire off a few trades or you may fire off none. You know what I mean? So that's the way that I approach it.
Okay. All right, I'm going to do my best to try to read this next question. Hopefully you understand what he's saying. Given the tick value of the ZB at 31.25, traders with smaller accounts are restricted to trading one contract with a 3 to 4 tick stop if they want to control risk. Trading a one lot poses problems in terms of balancing the need to bank profit versus letting a winner run. Wouldn't it be better for traders with less capital to trade markets with a lower tick value, even if commissions then eat a bigger percentage of the profits? Ooh.
So yeah, so that was going back to what I was talking about here, where you have a big tick value in the bonds, and you have a low exchange fee. And so, and this is something like a lot of people don't get, again, unless you kind of worked at a firm, and then you start to see you can become a member and lease a seat, and you can fire off more trades because you're paying a lot less money in terms of fees. It is a high tick value, and actually in the beginning I do recommend that people stick more with the 10-year because it's half that size. So the 30-year is $31.25, the 10-year is $15.62.5, and then the 5-year is half of that. It's $7.50 and change. So in the beginning, yeah, if you're a one-lot trader, you would be better off focusing on the 10-year or the 5-year for your trade execution, but also watching the 30-year for potential clues. You know, yeah, it definitely can be a little bit limiting because it's $31.25 a tick. Still, if you become decent though, that take to commission value really saves you a lot of money over time. But I usually recommend people stick with the 10-year or like the Emini S&P or the Euro stocks. You know, it's because the Euro stocks is a low value as well. So yeah, hopefully that answered the question.
Okay. This person asks, what prop shops trade bonds, and how do you get hired as a trader at one of them?
That kind of goes beyond the scope of today's discussion, to be honest. If you do some research online, though, there's a lot of different shops out there. I have some listed on my website, just a quick link just so you can see it, because I have you up here too. Under my free info and links, there's some recommendations for different sites. I have some proprietary firms where I've talked to people who work there. These are a few of them. Getting hired at a firm is, you know, there are some firms like TopStep. So TopStep gives everybody a chance, right? So you can trade from your house, which is kind of the beauty of that scenario. If you want to get hired at a firm in-house, you will typically need to move to a big city, whether it be Chicago, New York, London, Singapore, or maybe Sydney, Australia. And you got to go in. You have to land the interview in the first place, which, you know, I mean, they get a lot of applications, so it helps to, honestly, it helps to have these days a background in mathematics and statistics. If you have a degree in that, all the better. But what you would find if you look at some of those sites and if you talk to traders, even the ones that are on my site as well as ones that I don't have mentioned on my site, predominantly they start traders on interest rate products. And that was the case in Chicago as well. It's not very frequent that you find people that are on energy desks or grain desks or things of that nature. It's more specialized in these days under the realm of HFT programming. So that's where the background and stats and programming and where your quantitative analysis comes in, if you've watched any of the YouTube videos like the black box stuff.
Okay.
That's about the best I can do today. That could be an hour-long answer.
Yeah. Can you talk a little bit about the NOB?
The knob is so the knob is just a spread, which is the 10-year notes against the 30-year bonds. And again, this is a topic unto itself. But essentially, what it is all day long you have major banks and principal trading firms, which are also market makers usually, working orders on both sides. And so again, this can get a little complicated for a presentation like today, but what they might be doing, for example, is they may be working an order to buy 500 at the 10-year at 28.5, while simultaneously working a sell order to sell 100 or 120 at 06 in the 30-year. And what they're doing is they're trading the spread between the products, which is based on the yield curve. And so I don't want to get too far into this, but all the major funds and banks watch the yield curve, and they're usually trading future spreads on that, and they're also trading futures versus cash. So they might have an inventory of cash bonds in-house, you know, that they already own, and they end up buying 10-year futures against their 30-year cash, and that gets a little complicated. But it's the same thing as if you're running a fund and you own a basket of stocks in the S&P, and then you sell contracts in the S&P futures, right? So I would recommend, if you're interested in that kind of trading or spread trading, just do a little research online, and you can find quite a few good articles that explain the knob and the fight in cash versus futures. You could read on it for about an hour or so before you start to get it.
Okay. All right, let's see. There's a person asking, what is your opinion on would be valid markets in the Asian markets? They're looking with the necessary liquidity and everything needed to trade like you do.
You know, unfortunately, I'm not real familiar with them. I know that a few people have started looking at that mini Nikkei over there, the 225. But those markets, as far as I'm aware, are pretty thin. Like I've looked at the HSI and the SPI in Australia and whatnot, and so I wish I had a little more feedback on that, but I don't in terms of Asian markets. I know that a lot of people that I talk to in Australia and Singapore, Thailand, etc., they'll trade the Eurex markets because those are still, decent in their time zone. If they try to trade the U.S. markets, I get it. They may be awake at midnight their time, trading from midnight or 11 p.m. or 1 a.m. till 4 a.m. So that's pretty hard. So usually I tell them to focus on the Eurex products during their afternoon or evening hours. Yeah, I wish I had more to offer on the Asian situation, but I do not.
Okay. What is your opinion of trading currency futures?
Again, I think they're very thin. If you look at, for example, this is the euro. The 6E here is the euro on the CME exchange. You'll find areas where it will do the same thing as what I showed in the gold trade earlier, which is it may snap through an area by 6, 8, 10 ticks, and then immediately within 2 to 3 seconds snap back to the kind of the break point. So I typically tell people to stay away from it because again, it's pretty hard to trade it without having a very wide stop, and that wide stop is based on conjecture. I mean, it's not. It might be based on like a chart technical support, but in reality, in the moment, you have HFTs just whipping it around, and it's real easy to get whipsawed.
Okay. Next question is, there's 3 or 4 questions, so I'm going to try to combine these together. They're asking about the Ultra Bond and what is your view of it?
If you become proficient at watching the 10, the 5, and the 30 without the Ultra Bond, then you might want to incorporate the Ultra Bond in there as well. It can occasionally offer some clues, but I typically don't recommend trading it because it's the thinnest of the Treasury products, and so again, it's a little easier to control your entries and exits in the 10-year or the 5-year and to manage your trades than it is in the Ultra Bond. So it can be a good addition as something to watch, but I wouldn't recommend executing trades in that.
Okay. Okay, these next 2 are going to be towards you. Do you scale into and out of winners and losers when you're trading?
I do not. That's a personal preference thing. Excuse me. It's not that it's not valid, obviously, but because I'm often going for short-term type plays and maybe playing within ranges for a few ticks, I prefer to use an all-in, all-out type method. Usually when people start trying to experiment with scaling strategies, they end up inversing their risk to reward. And again, that's another thing that you can talk about for 40 minutes. But what happens is they often end up in a situation where they're trying to scale out because taking money off the table makes them feel good, but in the long term, the scaling out often creates an inverse risk to reward scenario where maybe they were risking 5 and only getting 2 takes out of the trade or whatever. So for me, I typically am all in, all out on most trades. If a trade's going in my favor and I think I'm on the right side, then yeah, I'll double up and hit it again, and try and ride it for as long as it goes. But then when I'm out, I'm usually out, and then I don't double in or average into losing trades. I find that typically the quickest way to the poorhouse.
Okay. Next question is, what is your average stop loss when trading bonds?
It varies completely with the situation. So depending on the scenario, it might be 1 or 2 ticks, or it might be 4 or 5, although typically never more than 4 to 5. With the 30-year bond, that's with 10-year notes, and with the 5-year notes, with the 30-year bonds, you're probably going to be more at 4 to 5 on a regular basis. So again, that's why I would say stick with the 10-year and the 5-year for now, or in the beginning when you're learning.
Okay. Next couple questions are kind of geared about Jigsaw. Let's see. Are you using the Vista map for assistance with order flow?
So I don't really use it, but it's not because I don't like it. I really like the feature, and I think it's very helpful to new traders trying to learn order flow. So I do recommend, for example, if you're going between normal candlestick charts or the Auction Vista feature, use the Auction Vista feature because it's showing you where depth is building and leaving and where real volume is trading, and volume that's bigger than average is trading, and that can be important. The reason that I don't have it up usually in my workspaces is because when I first started trading, it didn't exist. And so when I first started, I was trading on TT's X-Trader, their market depth, and that was really the only market depth platform available to anybody. And so I kind of learned to watch all of this by watching the TT thing. So I watch just the DOMs because I have the experience doing that. But yeah, I think the Auction Vista is a pretty good tool that people can use to help them understand all the basics when they're learning.
Okay. What is the monthly running cost for the data feed and Jigsaw that one would need to trade your style of trading?
It's actually very inexpensive, and that's another advantage that retail traders have today that most people didn't back in the day when I was starting. Your broker typically provides a decent data feed. I mean, the standard these days is CQG or some variation on CQG, and usually that's free. So whatever broker you use, I guess except maybe IB. If you're using interactive brokers, I don't use them, but I understand their feed is not very reliable. So in that situation, you might need to purchase like IQ feed or Kinetic. But usually you can open an account in the States and they give you CQG for free. Well, they charge you a per side transaction up to a certain cap. But so your feed is free, your platform, your main platform is typically not very much, and then Jigsaw is $3.99 for a one-time cost, and then it's $50 a month if you want to place your orders directly from the depth of market, which is what I recommend. So really, for like $50 a month, or maybe a little more, maybe 100 and something, you have the same type of setup these days that used to cost $1,200 a month when the only option was TT or one of those big firms back in the day. So yeah, I mean, really overhead cost is pretty minimal these days.
Okay, when doing research on different markets, what should we use as a benchmark to measure whether a market is liquid or thin?
When doing benchmark testing, is that what it was? I'm sorry, I missed the first part.
When doing research on the different markets, what should they use as the benchmark to measure whether a market is liquid or thin?
You typically want to see a couple hundred at each price. So if you look at this screenshot, you see 700 by 1300, you see 800 by 400, 800 by, well, there's 36, that's because it was trading, but 800 by 1000, 13 by 13, 500 by 500, or even 280 by 370 or whatever. That's liquid. 11 by 26 is not very liquid. 11 by 3 in the DAX is not liquid. So the main products would be Treasury notes, Treasury bonds, Emini S&P, Eurostoxx 50, maybe corn, or there's euro dollars and stuff like that in the shats, but they're really, really, really slow right now, so they're not very good for volatility. Thin products would be all of these. Would be typically your energies, your other grain products. Soybeans aren't very liquid. Metals, that kind of stuff. So, and the CME currencies. So that's the benchmark that I would use when looking at a product.
Okay, I'm going to make this the last question, and I'm going to combine a couple here. There's a couple different people asking about stop loss and profit targets, whether it's acceptable to use automated or mental or bracket orders?
Whether it's acceptable to use bracket orders?
Or automated stop
Yeah.
loss profit targets, or just mental?
Yeah. I mean, yeah, absolutely. No, I mean, um, it's definitely valid to set up. Like there are certain platforms, you know, that you can set up automated trading management strategies. So certainly, if you're in a situation where you know you want even this trade where I want to go short, but I want an immediate stop set at 30 or 30 half and a target of 27 half or 27. You can use a strategy like that as a hard stop, and particularly if you have discipline problems, you know, and just you don't touch it, you let it go. The thing about thicker markets though is sometimes you may have a profit target of 3 or 4 ticks, but then when it gets 3 or 4 ticks in your favor, you realize you're on the right side still. And so if you have a hard stop there, you get taken out for a 4-tick winner when you could have made 7 or 8 ticks on a trade. So I often will somewhat discretionarily manage those types of trades. Now, if I'm looking, you know, if you're looking at these kinds of scenarios in thin markets, again, it's not that I don't think a person can trade a thin market profitably over time, but I think in today's world, you have to use an automated trading strategy like that where you're using stop orders and trailing stops and going for profit targets that are reasonable targets based on the average of that market.
Okay. Well, thank you for today's webinar. As always, it was very enlightening and informative, and I enjoyed it.
Thank you very much for having me, sir. I hope everybody got a little bit something out of it, and thanks for watching.
Can you pull up your contact page real quick so that way if anyone has any more questions or comments, they can contact you?
Sure. It's nobsdaytrading.com, and you just go to the Contact Me page, and then you scroll down, and it's just your basic contact form with a little bot thing and send message. And yeah, so if anybody has any questions, please don't hesitate to email me. I'll always answer emails, no matter what the question is. If it's, some people think they're asking stupid questions, but there aren't any stupid questions, as teachers always say. So yeah, hit me up anytime if you have questions.
All right, sounds good. Thank you for your time today.
Thank you very much, sir. I appreciate you having me back, and I hope you have a good week.
You too.